We start today's market talk. Despite what the breathless headlines might suggest, the current market decline isn't particularly special. The reason why I'm saying is because this is normal. This is normal in equity markets. If it rises too much, then there is a mean reversion and it corrects also. So it comes back, it corrects also slightly too much and then it reverts to the mean level where it should be. So we have had a good session over the last 1 or 2 years. So now we are just giving back some gain. So it's okay. So in such times, we must recognize that market volatility is natural and use these opportunities to review your asset allocation. If you are too bullish or too taking too much of risk in your portfolio, you have to stop doing that. And if you are investing for next 5 to 10 years, this decline will be a very good opportunity to add on to good stocks, and this decline would be as memorable as last year's IPL. Okay, market outlook. I see, as I see it, first is the incoming US president's policy of strategic ambiguity is hard for the market to process. The problem is market doesn't likes ambiguity, uncertainty. Right now there is too much of uncertainty. Now, just for an example, during the campaign, Trump talked about cutting taxes, reducing deficit, increasing tariffs, and reducing inflation. I'll repeat again, cutting taxes, reducing deficit. Now, how can both of them work together? Increasing tariffs and reducing inflation. They are all contradictory. Now, what market believed was that there would be deregulation, productivity boost, etc., and that is why U.S. stocks were in momentum and they were going up. But now people are realizing that these are contradictory stuff. Though US has the best tech companies, best consumer market, controls the world's finances, etc., it controls the world's reserve currency, etc., and it leads in AI. And considering that US will likely to do well, a lot of money all over the world was sold off, equity sold off, assets were sold off, and money started moving into the US, thinking that there is a safety there. But now there is a big risk of massive global trade wars. Now, what Trump is trying to do is bullying actually, or to get a good bargain, etc., with China and its neighbors and trading partners. So he is trying to, give a threat of tariffs, etc. But nobody knows the final outcome. So in such an environment, when there is uncertainty, people like to be on the safer side and sell first and get into cash. Now, Indian markets aren't impressed by 6.7% GDP growth estimate for the second half of this fiscal year. Uh, so, what economists are talking about after a very subdued Q2, where the growth GDP growth was 5.4%, is that for balance half we will have 6.7% growth and maybe 6.4% year on year, and this trend will continue in FY26 also. That is normalization of the growth post COVID bounce where it has worn off is there. So that years of 8% plus growth are over. So if FY26 GDP forecast is also 6.7% only, so that is not giving any kind of enthusiasm to the market. And but markets are also taking cues from the cautious commentary which various companies which are in the consumer consumption sector are giving and are regularly giving for the information of everyone. Now, hence, we need a meaningful budget that comprehensively addresses the growth challenges. History has shown there is a strong correlation between government capex and growth. So they need to increase spending in defense, roads, railways, airports, affordable housing, etc. Now, this is key issue. Banking sector credit data showed that growth in personal credit has been reined in, which too would affect consumption demand. Now, if you have gone through the business updates of all the banks, which came out in the last 10 to 15 days, it suggested slowdown in credit growth and rise in stress across certain categories. HDFC Bank had a loan growth of 3% year on year. Union Bank 6% year on year, Ujjivan Small Finance Bank 10% year on year growth, while NPAs have jumped and collection efficiency has slowed. So unsecured loans, credit card loans, home loans, vehicle loans have all declined. So if all these loans are declining, consumption will not go up. And and another reason could be that there is a correction in equity markets, which also depresses consumption due to wealth effect, because people start are not feeling wealthy, so they don't consume much. And in the next few quarters, the NIMs will be under pressure as rate cuts, in case they come through, will also dent uh, the NIMs of the uh, banks. Now coming to technicals, this is the US bond yields, 10-year bond yield. So if you see here, they have risen and they have nearly come to 4.8. So as I have been pointing out, they corrected from 5% down to 3.6, and now they have retraced roughly 78.6% of the total fall. So now I had told that when it crosses 61%, then it goes full way. So it is expected that it may go up to 5%. And why it is happening is because better than expected job openings and along with significantly stronger than anticipated non-farm payroll data reported in December has suggested that labor market is now highly resilient in the US. So what is happening is that people are not expecting more than one oblique two rate cuts in the US in the next 1 year, that is 2025 calendar year, and people are pricing in higher fiscal deficit and higher requirement of government debt, etc. So the bond yields are automatically going up. In addition, now what is going to happen in the US is that the focus will shift to earnings season, which will start from the around 15th of January. But bond markets have sold off as investors, I told you, are worried about inflation due to heavy government borrowing, etc. Now, another problem is, so if you see the dollar index, this is also going up and has also now retraced more than 61%. So it has now reached 110 level and is also expected to go up, because all over the world, if the US bond yields are going up, money is moving in. So the dollar is becoming stronger and stronger vis-a-vis other currencies, because other currencies are now they are depreciating their currencies like yuan and yen and pound, etc. Now the Brent crude has broken through this declining trend line. This is because it went up to nearly 79 plus, as US has imposed some sweeping sanctions against Russia's oil industry. So that is another problem. So that is leading to rise in crude prices. And gold has gone up because this is basically safe haven buying, etc. Because otherwise, dollar index going up and gold going up is not possible. So gold is going up because there is a safe haven buying which is taking place. Uh, Now copper has also gone up because there is some talk about some stimulus, etc. in China, but nothing great about this. Bitcoin's corrected because the risk sentiment is reduced, so people are moving into safe haven. So it corrected a bit, but it is still higher. Now Nasdaq corrected around 2.24% last week and has come down to this basic trend line on which it is going. And Dow Jones also corrected. It corrected 1.86%. So it has come down to the lower trend line support. So we'll have to see from here. The problem is US investors want to see a strong economy, but not so strong that it causes inflation to pick up. So they want a economy which is generally doing well, but not weak also, but not very strong. Because if it's a strong economy, inflation goes up, and Fed will stop cutting rates and then may start thinking of raising rates. Uh, so, so that issue is the main problem. That too strong a economy also is negative for bonds, and then it becomes negative for equities also. Uh, because of this, whether the stocks can climb from here will depend on whether bond yields continue to move higher or they correct. Now, coming to India VIX, predictably it went up last week. because there was high volatility intraday and otherwise also, and a lot of people were buying puts, etc. So VIX goes up. USD INR. So if you see here, uh, it has uh, it has been steadily moving up, especially after Trump has come into the office. It was generally in a consolidating range, gradually moving up, and then from there it has taken off and has now crossed 86 level. So uh, weakness in the rupee is also causing FIs to sell. And the fall, as I have told you, has accelerated after Trump's election. That has led to spike in which led to the spike in US 10-year yield and the dollar index. A depreciating currency takes away the returns of FI investment. When the yield in their own countries are equal or better, why should they invest overseas and take the risk and other issues? And hence the reason for their FIs getting out of the or selling off is also very clear. So till the time this trend doesn't changes, FIs selling will also continue. Now coming to Nifty part, this is a weekly chart. So if you see here, it has now come exactly at its 50 EMA, which provides has been generally providing support and at the level where it was, the high it made on the in June on election day. Now this is a critical level, and once if this level breaks, then it will go down much lower. So this is a level at which it had taken support last time also. Now coming to Nifty daily charts. So if you see here, uh, it was consolidating within a range, but then this range has broken out, and now it has come below the 200 EMA very clearly. And the next level which people will be looking out will be the November low of 23,263, and if that breaks, then much lower levels are very likely, because that will trigger some algo based selling also. This is a hourly chart. So if you see here, Nifty last week has declined in all 5 sessions. Uh, so we are hoping that November lows will provide support. But for that, Bank Nifty has to provide support, because Nifty Bank has had a very deep correction. It has broken even the 50 EMA on the weekly charts, and it fell around 4.42% last week, and is below even the high which had made it on the June high, which it had made. So this is the worry. It has come down to much lower levels, and it can correct with this momentum. It can correct very fast. So if you see here, it was consolidating here. This consolidation zone has been broken. RSI is also now nearly oversold, and so it is coming down with momentum and has reached a new swing low now. So this 48,700 odd is there, and it can go down much lower, and likely level it can go down is these lows. This June, that election day low, roughly below 47,000 is what people are pricing in now, or looking, or maybe 46,000 what people are looking at as the low it had made on the election day. Now coming to, I have told you the reason for the fall. uh, It is coming down with momentum, and the fall has been led by HDFC Bank, which is the leader in the fall now, and it has fallen. Uh, it was trying to go up, but it has failed the breakout and has now come on the daily chart, has come now below the 50 EMA. So it can easily come down to 1600 and 1500 levels also, if this momentum continues. Hence, be very careful. Reliance has been consolidating around 1200 levels. So it tried to go up, but based on momentum of the fall, it corrected off. But it is one place where it is trying to, along with IT, supporting the market. Now the other problem is mid caps. The broader markets, it was looking that it was moving counter trend to the Nifty and Bank Nifty in November and December, but now that is going away, and it is now also coming down to this support. And small caps also, similar thing. Big red candle, 7% fall last week, and lot of popular stocks are selling off. Uh, so if you see, Nifty has four major indices: banks, IT, auto, and FMCG. The banks I have told you are selling off. PSU banks are faster than the private banks. HDFC Bank is also down. Only person left is, or the only stock left is ICICI Bank, which is trying to hold things up, but only ICICI Bank cannot hold. IT sector is holding up. TCS was inline results. So IT sector rose on Friday. So this is one sector where people are hiding in now. FMCG is down. Autos is also consolidating after a decline also. So if top four sectors are not being supported, then Nifty's next leg of momentum can only come from budget only now. Otherwise, right now the selling pressure is too high. Uh, right now we are oversold, so we can have some bounce, but then that bounce is also getting sold out because people are exiting the positions where they are stuck. So best hope is good earning season and a budget to repair the sentiment. Uh, but hope is not a good strategy, so it is time to face up to the realities now. So that is my point. Now I'll cover a few stocks. First is Ganesha Ecosphere. Pet recycling and pet bottle recycling market is expected to grow 27%, 147% CAGR over next 6 years to 2.8 to 1.6 million metric tons. By FY27, it will have 87,000 metric ton per annum. That is in two parts, Warangal and Odisha, of value-added food-grade recycling capacity, catering to 10% of the 910 kilometric ton per annum of recycled PET bottle demand. So it will have around 10% of the market, but still it's a big market. Its facility and products are US FDA and EFSA and FSSAI AI approved. Also, multiple global brands have approved the product for its stability. Exponential growth in recycled PET bottle market to drive volume revenue CAGR of 24% and 26% over FY 24-27. 450 crore greenfield expansion at Odisha to set up 45 kilometric ton per annum of rPET granule capacity is expected to be completed by March 26. Project is expected to have asset turnover of 1.25x and is expected to reach peak capacity utilization within 2 years of commercialization. So if you see here, the revenues are rising now, and uh, the big surge has come in FY25 only, where it has surged around 40% and is now expected to from here go up around 20% from here. So it should do a EPS of around with better margins, etc. ROE, etc. are improving. EBITDA margins are improving, etc. So it should do a EPS of around 60 bucks in FY26 and around 80 bucks in FY27. So taking a mean of 70 and multiplying it by around 25, 30 times also, this stock is reasonable. So if you see, it has got number of manufacturing facilities. Basic facilities are in Warangal and it's coming up in Orissa also. Otherwise, they have facilities in Kanpur, Rudrapur, Bilaspur, Temra, and in Nepal also. They have increased their install capacity over the years to for various stuff. So this RPSF is recycled polyester staple fiber. So they were providing that, and HDPE, high density polyethylene, and PP polypropylene, etc. So they are increasing their capacity and getting into value added stuff. So the production is rising. The revenue growth is steady now after the trajectory has become much faster. EBITDA margins are improving and return ratios are also improving now. So if you see this stock, it was in that range of around 1000 odd, and then it suddenly took off. And then now with high volumes, where the results were good, etc. So now it has corrected. It's come down to its 200 EMA. So as we have discussed, around 70 FY 26-27, around 70 rupees EPS. So it can easily trade in a bull market at 30 times and in a bear market at around for 20-25 times. So considering that, anything between 1500, 1600, if it comes in this momentum, should be a decent opportunity to buy this stock. So though otherwise, like if you see here, it took off from 1600 levels where that rise came. So this should be the decent strong support because it is falling with momentum. So with this momentum, it can easily fall to these levels, but that should be an opportunity to get this stock. It is oversold now, so a bounce is expected. Next stock is Syrma SGS Tech. It's a technology based engineering and design company engaged in turnkey EMS. The company's products primarily cater to ODMs and OEMs that find end use in automotive, healthcare, IT, industrial appliances, energy management, water purification, power supply, and consumer product industries. Q2 EBITDA margins were up 149 basis point year on year at 8.5% after many quarters of subdued performance. And that is the one which led to re-rating of this stock. Revenue growth was led by consumer, healthcare, and railway segments. Superior product mix drove gross margins. A strong order book of 4,800 crore and a revival in exports support FY25 guidance of 40% plus revenue growth and a strong conservative 7% EBITDA margin. It aims for rupees 1,000 crore export revenue in FY25, mainly from industrial and medtech. Order book is constituted basically by auto, industrial, consumer, which they're trying to reduce because the margins are low, and healthcare, which they're trying to increase. It added nine new clients in first half, having 500 crore revenue potential. New Pune campus has 1,500 crore revenue potential, so they are doing capex, and large part of capex is over. Smart meter, they are into that also. Sold 13 lakh units in first half. Aims rupees 350 crore revenue from domestic and 100 crore revenue from exports in FY26. Recently, just on Saturday, this news came. Their laptop assembly line in Tamil Nadu, Chennai, has been inaugurated, or foundation stone has been laid in partnership with MSI. MSI is a company of Taiwan. They got PLI net inflow of around 15 crore in FY25, mainly in telecom. IT is expected to start from fourth quarter FY25 and MedTech in FY26. So they are likely to be PLI beneficiaries. So if you see here, uh, the rise came due to second quarter because the revenue was up 17% year on year. EBITDA was up 42%. This is because the gross margins went up, and Q on Q, the gross margins were up nearly 941 points. That is from 15%. For Q1, the gross margins went to 24.4 because of better management, and EBITDA margins also moved to 8.5. But they are saying around 7.5 is reasonable. It had come down a lot, and that had led to the de-rating of the stock. Segment revenues, what were rising year on year, auto, healthcare, and industrials. And if you see here, the revenues, if you see here, for half of the year also, first half, it has risen around 52%. So that is what is driving the stock. So if you see auto revenue trends is rising, consumer revenue trends, they're trying to reduce this part. Healthcare revenues are improving, industrial revenues are improving, and IT and railways are also improving. And now with these projects they are getting for assembly of laptops, etc., they should do well. So if you see the growth now, growth is steady. Only the volumes were declining now. So they are expected to grow around 40% revenue growth, and if the margins are steady, so that should be good. So they are expected to do around 15 EPS in FY26 and around 20 odd in FY27. So taking around 17, 18 EPS. Uh, ROE is improving. ROIC, return on invested capital, is also improving, etc. So PE would be coming down. So now if you see this chart, this stock was declining because of poor performance. And decline in margins, etc. But now, after the Q2 results, it rose up with large volumes here, where it was nearly oversold, and then it rose up with large volumes, and now it is correcting. So as we have seen, expected to do around 17, 18 rupees now, but you have to see you can't rely on one quarter's performance just to judge this. So please see this quarter results also. So if the trajectory continues of better margin. So if it is expected to do around 18 bucks, so roughly around at 30 times, if it comes to this 520, 530 levels, this should be a good opportunity to accumulate this stock, because this is where the money is coming in. And in terms of EMS, this is relatively cheaper as compared to peers like Keynes and others, Amber, etc. Or Dixon also. Now I'll cover Dixon now. Uh, Dixon is having regular news flow related to new businesses from existing and new customers, and it is venturing into new businesses and industry specific news related to display module and IT hardware opportunities. It made a joint venture with Vivo to manufacture and supply electronic devices, including smartphones. So this will increase the market share of smartphone assembly business to 22 to 23% and 20% overall mobile market. So basically, this Dixon is having 20% of the assembly business in mobiles in India. It has partnered with Taiwan's Compal Electronics to make Google Pixel devices in India. It has collaborated with Nokia to manufacture fixed broadband devices. It will start making mobile displays by second quarter FY26 as part of its backward integration strategy, which will boost margins by 100 basis points in next 24 to 28 months by joint venture with China's HKC. It expects component share to increase from 18% currently to 35% in the same period. So that will improve its margins. IT hardware manufacturing to kick off in fourth quarter FY25. It booked 74 crore PLI incentive during second quarter and 124 in first half. New facility in Noida to supply for 400,000 smartphones per month. That is roughly around 4 lakh. Currently, monthly run rate is 28 lakh units without Samsung. It may fall up to around 23, but revive to 30 lakh plus in fourth quarter and 35 lakh in subsequent months. So this part is of the business is doing well. That is the mobile phone. Smartu is estimated to clock. They have acquired this company to clock 7,500 crore revenue in FY25, and supply to Compal is expected from end November uh, this year. Management expects IT hardware to replicate similar successes of mobile. It has said that at least in next 6 7 years, it will do around 48,000 crore revenue under IT hardware PLI scheme, and plans to invest 150 crore in phase one for 12 lakh units capacity, having 4,500 crore revenue potential in 2 to 3 years. Supply to Assess is expected from third quarter FY25. It is also focusing on backward integration, PCBA, plastic molding, etc. It aims for in-house manufacture of 27% of bill of material BOM of an electronics item. So it is expected to do a CAGR revenue EBITDA PAT growth of 60% plus over the next 3 years, and high ROE ROC in FY27 at least around 35 to 50%. Now the advantage is if you are growing so fast, but if your ROE is less, then you have to either borrow or you have to do a equity dilution. So here, if the ROC, ROE, and cash management is good, then they can continue to grow so fast. So if you see here, they're expected to grow decently. CAGR is around 60%. EBITDA margins have come down, but should be maintained, and they are likely to do a EPS of around 220 in FY26 and 320 in FY27. So taking a mean of around 260 to 70, uh, at 50 times, this stock becomes around 18,000. So where it is right now and at roughly fairly priced, uh, ROE is improving, ROC is improving, return on invested capital is very strong. So this stock is really performing well. P is coming down. Now, the emerging businesses for this are telecommunication and networking products, set-top boxes, IT hardware, wearables and hearables, and refrigerators. So they are getting into this segment also. Now, if you see here, this stock has had a steady rise, right? And it has never fallen below the 50 EMA over the last so many months, etc. And it had gone up to 19,000. So it has corrected big time now and has corrected to around 16,700 level. So seeing the current gloom and doom scenario, so if it corrects a bit more, comes down to this 100 EMA at around 15,400, etc. This is a this will be a good opportunity to buy this stock because this is expensive stock. So and it is on the premise of that strong growth will continue, etc. And nothing can go wrong, etc. But the problem with these stocks is they are so expensive that they are priced to perfection. So anything goes wrong, they will correct very fast. So I have finished. We'll take questions now.